Hello everybody, I'm Peter Toogood, Chief Investment Officer of the Embark Group, and today we will be discussing finding the alternative without property. We've got some key learning outcomes. We'll do these at the start and repeat them at the end. Understand the diversity within multi-asset investing. Outline the challenges facing property allocations. What are alternatives? How should you consider using them in your portfolios? Key topics: multi-assets, thoughts and considerations, commercial property, reasons to hold, reasons not to hold, alternative investments, the weird and wonderful and the mainstream, and learning outcomes. So we'll begin with the multi-asset universe. It is an incredibly complex landscape. I've been doing this for 30 years, and each year more product seems to come, more ways of investing seem to be offered up to us. Investment companies have definitely met the demand with the solutions they offer. It is a kaleidoscope of potential opportunities. But, and this is the issue, for investors, for people like us and for your own clients, multi-asset funds can have the following. They can have very similar formal objectives, but often have very different outcomes. Certainly in terms of risk, but as importantly, obviously risk and return. Feature in different IA sectors. Often you'll see an asset allocation from some common funds that you think are similar, and they're vastly different. We'll investigate this more a little bit further on. Finally, they vary in the scope of their investment. What is the driver? Is it asset allocation purely? Geography driven, market cap driven, style driven? Is it a value fund? Is it a growth fund? And most important of all, and often missed by many investors, the currency effect, which obviously, given since Brexit, sterling's relative weakness has been a major factor in returns for global portfolios in particular. Finally, in the world in which we operate, the world of analysis, the nature of the benchmarks they use, the often different reference points that are adopted by managers for deciding their relative success or failure in achieving their objectives. And again, we'll go into that in more detail very shortly. A pictorial, which hopefully is a useful way of understanding what we do every day, by the way, as fund analysts, which is analysing funds. The kaleidoscope is very visible now, which we like enormously. And in the middle is the most important thing, asset allocation. It starts in the following frame for us. First of all, is it passive or dynamic? And by passive, I mean, is it a medium-term strategic asset allocation process, or is it actually a dynamic process? Does it have a dynamism to the way it is managed through time and indeed through market cycles? And even within that, is it relatively strategic, i.e. does it take a one-year view maybe, or is it actually very, very tactical? Is it a constant evolution of asset allocation? No rights or wrongs, but it's important to clarify right at the start, what is the beast you're dealing with? And then around the edges, you'll see all the kind of things we would analyse when we're looking at what is often a multifaceted, multi-headed fund. I think first of all, we try with manager preferences, and that there is really understanding their proclivities in terms of equities, in terms of fixed income, in terms of any other assets they may include in the portfolio, and understanding what are they trying to do with this product and how do they think about mixing assets. When we've decided what kind of assets they typically will include, which is where the preference begins, we'll analyze each of those in a separate fashion. So the bond profile, assuming there are bonds in the managed vehicle, what kind of bonds do they hold? How do they analyze them? What's the resource behind to analyze them? Do they like government bonds over investment grade bonds over high yield, or is it in fact the reverse? Do they like the high yield characteristics and perhaps don't use government bonds so readily? So again, just trying to garner the understanding of the universe of stocks and securities they'll pick, in this case, obviously securities with equity. We're trying to understand, is it a global approach? Is it a large cap approach? Do you just think global indices? Is it passive indexes used within this, or do you actually use active fund managers? And so again, the equity style, and then in relation to how it's actually delivered, market cap as part of that process. Do we have a dynamism in the way that is done as well? Does the fund move through the different cycles, in preference perhaps to small and mid caps at certain points, into large caps, into more defensive stocks, or more aggressive stocks? Within instrument type, perhaps more obvious to us is the cash market, where everyone just invests every pound we give them, but often there are some derivatives underlying. We want to understand what they're for. Are they for portfolio protection? Are they to enhance the return in some shape or form? Particularly in the total return space, a great deal of use is made of derivatives to achieve certain goals. And within the mainstream vehicles, often mainstream funds, the more typical absolute relative funds rather, sometimes we're looking to see if they're deployed for defensive reasons. And the overall strategy must come together for us in something that looks a little bit like an audit trail. So if we understand that the fund perhaps is focused on income, that's fine. And we're looking to see that income is the first priority in the fund. If it's looking for capital growth, and typically a 3 to 5 year view, we're just trying to see if the ambition of the mix of assets is likely to achieve that, and the focus of the underlying securities. Takes a lot of work, takes a lot of time, and takes a lot of energy, to be absolutely blunt. So what lies beneath? This is an important slide. So again, back to the comment I made slightly earlier, which was what is average? When you see the IA sector averages, which aggregate all the funds of different flavors, but within certain boundaries, this boundary here being the 20 to 60% in shares, big breadth there, 20% or 60%. It's a big number. And look at the medians and the maximums and the minimums. So here we're just saying the median, we'll call the average here, is 46%. But within this sector, we have some with 68% in equities. We have some with 2. By the way, don't ask me how they did that, but 2. Okay, this is absolutely incredible. When you look at the nature and scope of the book, how broad these are. The cash levels, again, these are extremes, but let's just take the maximum, the median. The minus 30 is obviously an aberration. It's a fund that shouldn't be there doing that, obviously. The maximum is 43%. So somewhere within this, a fund has 43% in cash. More typically, it has 7. And I think the most important thing is perhaps the gap between the bond exposures. 38% is an average, but some funds go right the way through to maximums and beyond. So within everything we're seeing as a context, by the way, most of the minimums will be aberrations. The point we're actually making is there's an extremity in terms of the breadth of bond and equity split. And it's something we focus very heavily upon because obviously it affects performance. If you take last year as a great example, anyone pro bond, particularly pro sovereign bond, obviously in particular, did rather well. They were rather pleased with their allocations, particularly against the UK equities, which were down double-digit figures. So within this, we're always trying to understand if the fund did very well, what was the reason for it? And it goes back to our audit trail. What is our audit trail that says this fund is consistent, the asset mix is consistent with the outcome? And again, for us, that's always the case. What have you put into the portfolio? Is it consistent with the outcome? So 5 funds that we picked on just to really bring home this point. And within this, the breadth of this, I think, astounded me. In particular, again, the cash levels, which I thought was startling. 21, 16, 4, 6, and 8 says it all. Some portfolios are only 4/5 invested. That may be for caution. That may be because of mandate reasons. It was a very cautious approach. Some funds have 64% in bonds, or 60, let's call it, 64. Some have equity at 30, 35. It's extremities. And within that, obviously, there will also be alternatives placed in there as reasons why. But if you look at the actual decision-making process here, someone's decided only 30% in equities. So Fund B, 30% in equities, 21% in cash. This is a cautious manager, but they sit in the same sector. And that's what we mean about kaleidoscope. It's a broad breadth of opportunity, but it needs deep analysis. So there's a summary. We go to the objectives. Are they realistic? What have they achieved in the past? The audit trail is key. Consider the ranges. That managers will often produce sand charts of the asset allocation through time. That allows us to look at the embedded biases. And again, then we're looking to say, if you've been more fixed income focused in the last 5 years, actually that's been a good thing, because fixed income has done infinitely better than the majority, not all, of the equity markets. So we will understand much more about how a manager's positioned from assessing the asset allocation ranges and making sure those biases are consistent with the performance. Drawdown is another great way of looking. Obviously, you could just look at March last year for reference, February, March last year, to see, was the behavior of the drawdowns consistent with what you'd expect to see in terms of the overall asset allocation setting. And then time horizon, acceptance of volatility risk. So here we're just trying to say, you've got to make a return or you've got to deliver an income. Are you taking a degree of risk consummate with that approach? Again, heavy cash weightings in funds mean you're not invested in either yielding assets or potential growth assets. That is a challenge, and that's the kind of thing we're trying to understand when we're looking at multi-asset vehicles and the nature and scope of them. So we'll come to, I think, our perhaps the highlight of our event, if I may say, in terms of the UK property market. And here we're going to analyse the previous efforts, the previous market in terms of, a history of the market, and to give you context to this market. So the commercial property market is actually 10% of the UK's total wealth. That's the value of every asset in the United Kingdom. And that down there would include commercial property, non-residential building, private rented accommodation, other residential. And you'll notice the other residential is nearly 5 billion. So of the UK's total wealth, it's approximately 50% is residential housing, and then infrastructure is $1 billion. So the commercial property market at nearly 900 billion is a very significant asset within the overall context of asset mixes in the United Kingdom. Its characteristics. So I think a lot of people might ask why it's always been used by managers. Those building out strategic asset allocations will often look to be asked the question, historically certainly, and even in today's terms, you put property in, what's the basis of that? So let's go to the real hub of it. It's an alternative source of income. Despite the fund suspensions last year and some of the other problems with the property sector, they still paid the income out. It was a nice steady income flow, you'll see shortly. Secondarily, and perhaps the most important of all, a differentiated risk return profile. If we actually look at the table below, we have got UK equities, UK gilts, corporate bond, property. We've represented that by the LNG vehicle here. Direct property sector, we think it's better to pick on a fund specifically. BlackRock Gold in general, and IX shares physical gold. So within this, we're trying to actually look at it versus every other asset class. And you can see, if you go along with the property fund, so go down 4 and then go along, very limited correlation with most other major asset classes. We're talking about de minimis, actually, very, very little correlation, which is why when an asset allocation machine, and after all, they are machines, comes together, what it's trying to do, lest we forget, is offer up a combination of all those assets and how correlated or uncorrelated they are. This is why you have diversification across multi-asset vehicles. And this is why most strategic asset allocation profilers, or asset allocations coming from a profiler, would typically give you a weighting to commercial property. It was an income producing asset class. Yes, it had lumpy drawdowns occasionally, but it had, most important of all, uncorrelated characteristics. That's why it was always being used. But the price of this, and this is now writ large, is if you are in commercial property, we do have an issue, and the issue is liquidity. From SEI, so thank him for that, we have on the upper axis, expected return. On the lower axis, we have relative liquidity. So here we are saying the expected potential return marrying up with the liquidity estimates. And the bottom line is it is an illiquid asset. US private real estate, by the way, is the US proxy for UK commercial property, is direct property. And as you can see, highly illiquid relative to others, with an expected return equivalent to large cap equities, emerging market debt, hedge funds, high yield. But liquidity is the price you pay for accessing this vehicle, as we've obviously all discovered. So that's the downside for commercial property. This is just reinforcing the point that it's primarily an income asset. The bars majestically moving along on monthly income show you that you've been getting a nice steady income. At the moment, many of these funds are yielding 5 to 6% as we stand today. But you can see within this lumpy capital returns. So I'm afraid the sharp drawdowns are where the capital appreciation, or in this case depreciation, both in 16 post-Brexit and more recently COVID, shows you that you do have this constant issue, which is related to subjective drawdowns, not easily anticipated. But I think you'll also notice that what we have is very sharp recoveries, actually in both instances, very similar to obviously the stock market on this occasion. The income carries on rolling in, even though the capital has been impaired for a brief moment, most of the time in time. What we're left with, obviously, the residual of this is the problem with suspended funds. So this is how we think you should use them. Whatever the outcome of the FCA's deliberations, I'm going to come back to this theme in a minute. The strategic asset allocation to the asset class within multi-asset propositions is being questioned. And if you look at the activity and behaviour of certainly most of the model portfolio managers and discretionary managers, quite a few have obviously removed them from their portfolios. If you look, we say the following: a long-term separate held investment to provide income, and it's a differentiated exposure. And I think if as an advisor you're still going to use this for your clients, that's where it's going to be most likely to sit. Secondarily, it can be tactical. This is where we have always disagreed with the market. From our perspective, when the yields are higher, it's typically contrarian. It's typically a moment of entering the property market. When the yields are falling, a lot more is priced in. It typically tends to rhyme with a peak in the property asset class. So if you are going to be tactical in this, it is yield that tends to attract or perversely detract from investing in this asset class. Whatever the conclusion in the retail funds world, however, it sits at the heart of most institutional pension plans. And I think this shouldn't be forgotten. A lot of the income you get out of your pension plans, either you or your clients, it's coming from the commercial property sector. And on the FCA deliberations, I know there's been a few people talking about the ISA withdrawal, et cetera, et cetera, et cetera. Having talked to the property fund managers directly, and we have, and they've made their submissions, we think the FCA is very aware of the issue that would be created if there were periods of notice put into holding commercial property funds. So jury is out on that. There's a lot of chat that it's all over and it's all done, but I would say and argue from this point on, it's not done and dusted. The FCA is still deliberating, and let's see and wait and see what they come up with. Right, let's get into the meat and bones. If one can't buy property, then what can one buy? Well, we've got the weird and wonderful world of alternatives as our title. What is alternative? And we do use this phrase readily. Overused, occasionally abused descriptor. What are investors looking for in alternative investments? So from our perspective, we're looking for a differentiated performance outcome. We're looking for a differentiated risk outcome. We're looking for a different source of income. We've just talked about properties virtues still within that. A liquidity premium, i.e. if you're willing to invest for longer, you do get the benefit of a liquidity premium. That is absolutely true. And so in each of the slides that follows, you'll see the potential opportunity, but that's always squared up against the potential illiquidity. So alternatives. Now, this is a massive cascade of potential things that if you had everything in the world to choose from, what would the pearls look like? And this is the key for us. Three assets in the middle: the hedge fund world, the bond world, and the real asset world. Okay, most of us will be familiar to a degree, I would think, with different kinds of bond profiles. You've got venture capital, you hear it a lot. Why is it that? Well, it tends to be risk capital lent out for people to undertake activities. Leverage buyouts, the ability to buy companies out with a great deal of debt, syndicated debt often from banks and others. Mezzanine debt, intermediate finance. It's finance that sits there as part and parcel of an overall debt structure. And then growth capital. Sometimes bond markets are simply there to provide funding for asset purchase, for working capital, and any things in between. But each of them represents the fixed income universe, but they're accessing it in a very different way from buying a traditional corporate bond or investment grade bond fund or a strategic bond fund. In the hedge fund world, they take the potential opportunities in fixed income and they move them into, again, what it looks exotic. It's event-driven. So event-driven is not as glamorous as it seems. Event-driven would be when a corporate takeover occurs, when M&A takes place, and the opportunity to take the arbitrage between the two. Maybe you own the acquirer or the acquiree. Either of those could be an event, and managers try to exploit. The prices tend to come together as an M&A deal is announced, and that's the kind of way they take advantage. In directional hedge funds, you're looking normally for long and short opportunities in equity space, and they may be directional as well. So that could be any market, anywhere in the world. It could be global, it could be regional. Relative value and arbitrage is often trading strategies, much more reminiscent of perhaps the sell side and the bond and the proprietary desks of banks. But typically speaking, it's exploiting market opportunities, but it is very much more trading orientated. In that regard, it gives you a different outcome. And then in the blue bars, the real assets, and we get as far as the more, quite frankly, entertaining parts of investing in real assets, which is wine, art, coins. Any of those would qualify as real assets. Precious metals, indeed, gold coins or otherwise. Commodities, and that could be an interesting trade moving forward. Oil and gas, real assets, as opposed to owning the equity, actually owning them outright. Not entirely ESG friendly, but the fact of the matter is it sits in the real assets bucket. So if you had your choice, if you could diversify, if you were a pension fund with unspecified duration with a set of liabilities, those are the kind of potential things you could mix into your overall asset allocation. Indeed, many and some of those do feature in some of the more esoteric funds that we do look at. But in our world, in the world in which we operate, and in the world in which we sit with our clients, what are the mainstream alternatives? And by mainstream here, I mean that if they're included in daily dealing retail multi-asset vehicles, that they don't prevent a liquidity issue for them. Again, broken down into what you would call, I think, three key areas where I have seen and we have seen multi-asset funds invest in previous times. Let's start with fixed income. So we go back to core, which is your sovereign government bonds. There's plenty of them around at the moment. Investment grade, so your traditional safe blue chip companies. High yield, more leveraged, more debt, more cyclicality. And then aggregate. So in other words, maybe the strat bond funds you'll buy and find in the marketplace will take advantage of any of the above three and buy across the spectrum of fixed income. The alternatives to that, an absolute return mandate. So taking the core, but actually trying to deliver an absolute return within that. And there within that, you could be looking at saying, I will or won't be invested in X or Y. I believe this will make me money, won't make me money, but you're looking for a total return. And a total return here being a positive return. Credit long short. You can go long of the credit, short of the credit. And there are long short funds out there that do this exactly the same as the equity funds do. They take advantage of both sides of the trade in fixed income, looking for deteriorating credits on the short side, and obviously going long on the long side of securities they like. Relative value is simply exploiting the opportunities across the whole marketplace, more trading strategy orientated. But within fixed income, you don't just have to have the core, you can also have the alternative way in which you can invest within the asset class. And again, that's the point. You can invest in bonds, but you can do it in a different fashion. Ditto with equities. It's the same principle within equities. You have alternatives in the form of equity long short. A very traditional understood, I think, and you can see in the US market at the moment, quite topical, I know. You can see the shorting activity and the effect this is having upon the US stock market currently. But there's very well established managers in the equity long short space. They also do this in a market neutral fashion. And here they're saying they're trying to take out the beta, and that is, i.e. the market direction, by having a set of short stocks and a set of long stocks. And here they're trying to say, we think we can pick really good shorts, we think we can put really good longs, the direction of the market is irrelevant to us, and they'll create a market neutral fund. Finally, on the equity side, the core. It's the small, the mid cap, the large. I think this is often misunderstood. You can buy the passage, you can buy the indexes, but you can also buy a small cap fund, you can buy a mid cap fund, you can buy an all cap fund. You can actually buy something that's very specific to your thoughts about the market. So for instance, at the moment, if you were particularly bullish on a reflation trade, you might think more on the small mid capitalization issues, if that was the way you were thinking. And if you look at the second half of last year, that is exactly what US investors were thinking about the potential for a recovery. The US small mid caps massively outperforming. Second level of this in equities, obviously, is you can decide between growth or value. You can decide if you want to be desperately involved in the growth space. If you really are a firm believer in growth, all the winners are in growth, you stick with growth. On the other hand, if you think things have been discounted aggressively, airlines, travel stocks, you can name them yourself, you know what they all are. There'll be the COVID, unfortunately, the COVID victims, I should say, are all in that space. They are all in the airlines, the travel sector, the hospitality sector, that have really struggled. Obviously, as we've all been locked down, there are also opportunities. And then finally, I think a growing one, and this ties in with ESG as well, sector specific. And I say sector because often the ESG portfolios will be clean energy funds, they might be climate funds, et cetera, et cetera, et cetera. So an element of dynamism can also be present in picking sectors. Finally, just to finish off in terms of the mainstream alternatives, where we'd be looking there is core is cash. Obviously, you can't do much with cash anymore because cash in the bank is at zero in most parts of the developed world anyway. Certainly not the developing world, which we will forget. There are actually still real interest rates in nearly all of the emerging markets, and an opportunity to park cash there, but at a currency, potential currency hazard. Final alternatives we would highlight, event-driven, I've also already alluded to, the CTA, macro funds. There are macro funds. You'll know them. Sometimes they're rhyming with fixed income funds. You'll be aware of some brand names that claim and have macro funds. And they're just putting together all often directional and trading ideas, putting them into one portfolio and describing it as a macro fund. And there's another little wink, and you can do this obviously, it is catastrophic bonds, which is where should catastrophic events occur, you're part of a reinsurance program for that. So again, each of them is either a way of investing differently, is a different kind of asset class to bring diversification, can be included potentially in daily dealing formats, which allows people to access readily something that they wouldn't get from a mainstream cash, typical sovereign core bond, equity blue chip style strategy. So it's just to highlight that although we have potentially lost property in most cases to selections in the future within model portfolios, to be discussed, but potentially we have, there are other ways of accessing vehicles, but they are fairly limited. At the end of the day, they're going to most focus around equity and fixed income. There are potential alternatives that one can take in there. There are liquid alternatives that are offered up, but it's a fairly de minimis universe. And one would have to say that to really maximize the opportunity of alternatives, you do need a duration line. You need to think past daily dealing vehicles. It's very hard to access the bulk of those alternatives in daily dealing formats. So what have we actually taken on board here today? We've taken on board that there are alternative equities, traditional long short, market neutral. We've taken on board that within fixed income, there is absolute return, there is credit long short, there is relative value. Each of those expressing a view positively and negatively about fixed income securities. And finally, other, event driven, M&A, CTA macro investing, i.e. just taking positions based on your macroeconomic views, and finally catastrophe bonds, which are risk-linked securities and put you into the insurance world. So there are alternatives, not multitudinous, but there are some. So let's summarize where we've finished this. Understand multi-asset investing. Where should you be? Is it growth or value? Is it bonds or equities? Is it alternatives? Have we got an alternative universe sufficiently broad enough for us to access? And the answer to that question would be, we do. The scope, the scale of which those are layered into portfolios will obviously be discretion of the fund manager. And what we're trying to do is in the overall picture of the objectives that they're setting out, if you include something that is alternative, if there's something in there that comes along that shouts alternative to you, what's the nature and scope of that? And does it change the dynamic of the portfolio? On property, outline the challenges facing property. Hopefully I've explained, from our perspective anyway, that the income credentials of property should not be dismissed. The conclusions of the FCA consultation are not yet apparent. We don't know what the final scope of them will be. The property sector does offer a diversification away from bond and equity. It does. The correlation characteristics are very clear for all to see. Still merits a place. The liquidity issue remains very current, and we shall see after the deliberations what it means, but there is still opportunities to hold these assets standalone for clients. And indeed, I know many advisors do in fact own for their clients commercial property, student accommodation, all variations of property, because in the end of the day, it's nearly 2/3 of the wealth of this country is invested in one shape or form in both commercial, residential and infrastructure. That's a big statement about the scale and size of property, and it's not going away anytime soon. And to finish off with, by the way, I think the idea that the entire commercial sector is struggling under COVID, we won't ever return to offices, I think we all know that isn't true. And for one office that is not being occupied, there's an industrial site that is definitely being occupied, and there's certainly a retail warehouse being occupied. See Amazon for reference. So the commercial property sector is also constantly evolving. It's not just an office, it's not just a high street retailer. There's a lot of breadth and depth into this in underlying commercial property opportunities. Finally, alternatives and how you consider using them in the portfolio. From our perspective, I hope we've outlined there are illiquid alternatives. They're interesting, they're different, and they definitely should form part of your portfolio for clients, but they're not on the platform. They're not going to be invested in the platform. They could be an E-type Jaguar, a bottle of wine. Hey, that's fun. But there also are mainstream alternatives. And here we have described, I hope in glorious technicolor, that there are alternative kinds of instruments to invest in, and there are alternative ways to invest those instruments. And hopefully we brought together the idea that, yes, in the future, perhaps there is another layer of sophistication that these products can move to. For today and for now, the bulk of these funds are mainstream vehicles. They're not putting a great deal of weighting into alternative investments. And I think the more traditional balanced funds, managed funds, are still the route for most investors today. I hope you've enjoyed this presentation. I now pass on to my colleague, Fraser Blaine.